Hi, I'm David Bassanese, Chief Economist at BetaShares, and I'd like to spend around about 10 or 15 minutes giving you an economic outlook, economic and financial outlook as of early September. Obviously, this is general information. I'm not aware of your own personal situation, so just general economic information as per I'm sure the usual disclaimers you've seen in presentations in the past. Now, let me just firstly start at a very big picture level. So this is what's the global PMI index. So it's really a survey of manufacturing and service companies around the world, taking in, United States, Europe, Asia. And as you can see, I've got there the Goldilocks zone. So when this index is in that sort of 50 to 55 zone, it sort of says that the global economy is growing along at a pretty nice pace, not too hot, not too cold. And you can just see we had the downturn way back during the GFC a decade ago, then the previous recession during the dot-com crash of 2000, 2001, of course, September 11, and just shows the magnitude of the downturn that we've had earlier this year with the COVID crisis. So these are various indices of global manufacturing and service sector sentiment did collapse with the economic lockdowns around the world associated with the coronavirus. But look, the good news is that they've had really a pretty strong bounce back with economies reopening, and trying to get back to normal conditions. So it's been a pretty heartening bounce back. I mean, there's still a lot of level of activity in many countries is still quite weak, but we have had a nice bounce back in some of these indicators. So what that means is that most businesses are now reporting that business conditions are better than they were in the previous month. So there's been an improvement in that sense from the major collapse. But as I'll explain a little bit later, even though these indicators have bounced back up into this sort of 50-55 zone, still means the overall level of activity relative to where we were earlier this year is still reasonably weak. Just looking at different countries and also splitting up that index between manufacturing and the composite, which includes both manufacturing and services. Just to show you, look, the rebound in activity across most regions has been fairly broad-based. I mean, China was probably went into a downturn earlier than most, locking down its economy way back in January. Other countries had to follow suit around about March and April, and as you can see, they followed with a lag. So China bounced back somewhat earlier, and then other countries have followed suit. Of those major regions, probably Japan at this stage is still bringing up the rear a little bit, so a bit more of a rebound to come in the Japanese economy. Now, one of the, I think, interesting developments globally compared to, say, a few months ago, this is a chart of, this is the US, but it's actually fairly true of most countries. The first chart is the number of coronavirus cases, sort of a confirmed case, a sort of moving average of daily new cases. So you can see they did have a wave back in March and April, particularly in New York and California. And they've had a second wave in some of the southern states like Florida, Texas, Arkansas. And in fact, the second wave is actually even bigger than the first wave in terms of cases. But what's been interesting is that the death rate during the second wave has been not as big. And this is true in Europe as well. If you look at countries like Spain, the second wave of cases has been as big as the first wave, but the death rate second time around not as bad. Now people are attributing that to various things. This time around, a younger cohort has contracted the coronavirus, and it's seen as young people partying during the summer months. And also suggestions that the latest variant, the virus has mutated in various ways, and the latest mutation that seems to be spreading is perhaps not as lethal as the first wave. But the bottom line of all of this for the global outlook is that we've long feared second waves with the pandemic. If you look at the history of pandemics, going back to the Spanish flu of 1918, you typically don't get one wave, you get a few waves. But if it's true that the death rate these days and as a result, that was leading to a risk of renewed lockdowns I mean, if we did get a big spike, the risk is that economies had reopened, they may need to lock down again. But if it is true that, you know, the death rates, the pressure on hospitals isn't as bad going forward, then we are starting to see more countries trying to avoid going back into lockdown, learning to live with the virus, so to speak, through, you know, use of face masks, limited social distancing, and, like, you know, reducing the number of people that can be at a restaurant at any one time, these sort of things. So that's, you know, good news going forward. We haven't obviously solved the problem of the coronavirus, but maybe to some extent we're learning to live with it in a way that can avoid those quite draconian lockdowns that many countries experienced back in March and April. Now, there are some exceptions, of course. Melbourne at the moment is going through a pretty harsh lockdown. New Zealand did go through a harsh lockdown, and it has sort of, you know, gone back into a sort of restrictive lockdown in one of its major cities. So there, with a few exceptions, the bigger picture here, I think, is that the risk of renewed lockdowns has certainly lessened, I think, over the last few months. The other, I guess, good news is that, you know, vaccine, you know, there's no silver bullet at this stage. There's no vaccine for the coronavirus, but, you know, there's obviously frenetic activity going on around the world. And, you know, more and more experts are suggesting we may well have a vaccine by early to mid next year. And certainly if it's early next year, and the federal government here in Australia, of course, is now established contracts with two of the leading vaccine candidates to have that available as early as next year. So it's growing grounds for optimism that we may well have a vaccine which would hopefully put an end to this crisis by early to mid next year. So what does all this mean for markets? If you just look here, I've got some major global market trends. The top one is the global PMI, global equity index, and you see we had obviously a collapse earlier this year with the lockdowns, but, you know, it's been quite a remarkable rebound in the equity market since that bottoming in March, being associated with ongoing declines in interest rates, so global bond yield. So that the second chart there is the yield on the global bond index. So it's an aggregate index of, you know, all the global investment grade bonds in the world. You can see the average yield on those bonds is now down around 1%. So central banks have come to the party. They've cut interest rates. The inflation outlook remains quite low. Central banks are promising to keep interest rates at very low levels for a very long time. And so that has helped support a rebound in the equity market. US dollars also weakened, which again is providing some support to emerging market economies at the moment. A weaker US dollar tends to, you know, encourage capital flows into emerging markets and out of the US dollar. So that's been a positive development. Associated with a weaker US dollar has been that plus low interest rates. We've seen a very strong rebound in gold prices. Now going forward, the outlook, I mean, as you can see, what I've got here is a decline in aggregate weekly hours for Australia and the United States. So it's declines from their peaks. And so it's an indicator of the you know, contraction in activity and then the rebound in activity on a monthly basis using this measure of aggregate weekly hours worked. And just to put the current downturn in context, you can see the previous recessions in the US. The last great recession in Australia was really way back almost 30 years ago, in the early 1990s. So as you can see, by the comparison of previous recessions, this one has been very, very deep and very quick. You know, so when you lock down vast chunks of your economy within the space of overnight, you can get a very major contraction activity. So we're having a V-shaped recovery in hours worked in the last few months. But as you can see, the level of activity or the decline in hours worked relative to their previous peak is still quite low. So there's a lot of spare capacity still relative to where we were. And in fact, if you look at the United States, for example, yes, hours worked has bounced back, but in terms of the decline from the previous peak, we're only back to where we were at the bottom of the last recession in the US during the GFC in 2008, 2009. So it just shows you that, yes, the rate of change has improved, but there's still a lot of work to be done to get us back anywhere near to where we were before the virus struck. And this just blows up the last performance of the last few months a little bit more detailed. You can see that we've had a nice bounce back in Australia and the United States in terms of hours worked. Something to watch though going forward is that at least the last month or so has shown a bit of a slowing in that rebound. We had an initial bounce, now it's started to slow, and what we don't want to see is that, you know, leveling off, and as a result, you know, we're left with a lot of spare capacity for longer than we would like. So that's something that certainly bears watching. As I mentioned, interest rates very low around the world. This is just a chart of the official, you know, a cash rate that central banks target, plus the dashed line there is market expectations for where they see that going over the next year or so. So as you can see, around the world, interest rates are effectively near zero. In Europe and Japan, they're in fact negative, and market expectations are for interest rates to stay at these very low levels for at least a year or so. Associated with that, long-term government bond yields, as you can see, also very, very low. So, you know, 10-year government bond yields in the US now are sub 1%. In the United Kingdom, close to zero, and in Germany, actually at a negative rate. So just incredible low level of interest rates that we're dealing with now in the global economy. Bigger picture though, look, in terms of the equity market, just make some comments on this. This is the chart again, that aggregate weekly hours worked measure that I showed earlier in blue, alongside the Wilshire 5000, which is a broad measure of the US equity market. And the grey areas there are US recession periods. And so there's a group in the US called the National Bureau of Economic Research, which basically define periods of recession in the US to the month. They tell us that with a lag, so we don't know when they, we only know when they begin and end with a bit of a lag. But as you can see, they have been associated with these big declines in aggregate hours worked, and then around about when they tend to bottom, they call an end to the recession. So at the moment, if you look at it, we've had this nice bounce back, and we've had this nice bounce back in the equity market. So there is a chance that we, you know, when in a few months' time, there could be the chance that the US recession is actually defined as already ended, because hours worked have bottomed and are starting to recover. So I actually think, you know, the risks of us having a relapse in the equity market and going through those lows that we saw back in March are diminishing as economies recover. But having said that, we've had a very strong bounce back in markets, and the chances are that you know, we may be due for a bit of a pullback. Just in terms of fundamentals with the equity market, so the thing I wanted to focus on here, as you can see, we've had this real V-shaped recovery in global equity prices. This is the index, and as a result, at a time when earnings have still remained quite weak, so a measure of earnings globally have remained weak, and as a result, the price to earnings ratio of the market has really gone quite high. So as you can see, at the moment, the PE ratio for the global index is around about 20, a level way above anywhere we've been over the past decade, and in fact at a level we haven't seen since the dot-com bubble 20 years ago. So that's the challenge for the market, is that it is at an outright high PE ratio at the moment, because markets have rebounded at a time when earnings have fallen. But I guess some good news going forward is that if you look at it, these are expectations for earnings for 2021, 2020, and that measure of earnings is basically a weighted average of expected earnings this year and next year. And as you can see, that we had a downgrade to earnings expectations in 2020 and 21, but they have started to level out. Now, if that remains the case, forward earnings from here can start to rise. Now, I actually suspect that this leveling out of earnings in 2021 is probably a little bit too optimistic. I think we are going to get some downgrades still to come through, which will temper that rebound in earnings for a while. So I think earnings could struggle for a little while longer. But at the same time, if you look at interest rates being so low, if you look at the valuations of the equity market relative to interest rates, and what I've got there is the blue line is the earnings yield. So that's the PE ratio. You invert that, you get the earnings yield of the market. You take away the current government bond yields, and you get what's called the equity risk premium, so earnings yield of the market less bond yields. And on that basis, you can see the market is actually not that exceptionally overvalued. At the moment, the earnings yield, or the equity risk premium, if you like, is around about 4%. It's at the low end of its range of the past decade, but certainly still, if you actually go back over time, it's averaged around about 2.5% over like a 30-40 year period. So the fact that it's only around 4% at the moment suggests that relative to bond yields, the market's not that expensive. So I just put it there that one thing we may be seeing going forward is that if interest rates stay this low, PE ratios around the levels we're seeing at the moment, i.e. around 20 times earnings, may be the new norm. It may be that the equity market is being re-rated higher given the very low level of interest rates. Low yields also supporting gold prices. I've got a chart there of the gold price against the real yield on US 10-year government bond yield. So that's less than, there's I guess an inflation indexed bond in the US. And so the yield on that is effectively the market's, it's the nominal yield less the market's expectation for inflation going forward. So it's a measure of real yields. And as you can see, real yields have really been falling since late 2018. The COVID crisis saw an acceleration of the decline in bond yields as the Federal Reserve started cutting interest rates. And gold prices have really been quite highly correlated with the trend in interest rates. Now, I think interest rates are going to stay pretty low, and then in fact, there's a chance that they may go a little bit lower over the next few months if the US recovery does start to slow and the Federal Reserve feels the need to do more stimulus, for example, and maybe expanding the balance sheet somewhat more, and interest rates drop a bit further. That's going to continue to support the gold price. But even if interest rates don't decline a lot further, the fact that they're going to stay pretty low, I think, is going to continue to support gold prices here. The other issue that we need to worry about just over the next few months, of course, is the US election. I've just got some performances of US equities just before, so 3 months before a US election, and then the subsequent 3 months. Now, the bottom line is that markets on average tend to be a little bit cautious in the month or so leading up to a presidential election. But then thereafter, then you tend to get a bit of a relief rally, once the uncertainty is out of the way. And I've just got some charts there showing that. In fact, if you look at it, the average performance in the 3 months before an election has been about 4.5%, not that bad. But afterwards, it's been about 7.5%. And if you look at the orange lines, the performance after elections vis-a-vis the performance before, typically you get a stronger performance in the months after an election before the election. Now, there is an exception to, I guess the worry that we have, particularly with this election, is that if it's a close result, such that Donald Trump loses narrowly, but then he wants to contest it through the courts. And for example, a lot of postal votes will be used this time around. And he may contest the validity of some of those postal votes. And so there is a risk of an extended court challenge of a sort that we saw back in 2000, for example. And this is just an example of how the share market performed in 2000 when there was a contested result. 20 years ago, Al Gore did eventually concede for the sake of political stability, economic stability in the country. He didn't want to keep continuing to drag it through the courts. But I guess the concern is Donald Trump may not be that willing to concede. So we just have to see, I'm just posing that as a risk. And the other performance we saw is in 2008, of course, where the economy was quite weak. And really the last leg of the downturn during 2008 came after during that election uncertainty. Well, not so much the uncertain result. Obama did win quite convincingly, but there was a period where the economy was weak and there was basically no one in charge, and it was only until Obama was basically sworn back in that Washington could refocus on the last stimulus package for the US economy during the GFC. And so the risk is that even if it is a close result, even if it is a clear result, it will be hard to get policy, any further stimulus if need be in the latter months of this year, just because of that election. So that's something to bear in mind, that this election is going to be hard fought, and if it's a close result and it's dragged through the courts, that could be a period of uncertainty that markets will need to deal with. So that's pretty much it from me. I hope you found that of interest, and thanks for watching.